Most traders become interested in a stock after it breaks out. The headlines appear. The price is already moving higher. Everyone suddenly starts talking about it. But here's the uncomfortable truth. By the time a stock explodes upward, institutions have often been quietly buying for weeks. Retail traders react to excitement. Professional money positions during boredom. And if you trade leaps, long-dated options designed to capture big, long-term moves, learning to spot this quiet accumulation phase can dramatically improve your entries. The goal is not to predict the future. The goal is to prepare before the crowd arrives. 1. The quiet phase before a breakout. Before almost every major breakout in the market, something interesting happens. The stock becomes boring. Price starts moving sideways. Momentum slows down. Volume looks quiet. Retail traders lose interest and move on to something more exciting. But what looks boring to most traders is often exactly where institutions are building positions. Large funds cannot buy millions of shares in one trade. If they did, the price would instantly jump. Instead, they accumulate slowly. They buy small pieces over time. They absorb supply from sellers. And this process leaves footprints on the chart. Once you learn to recognize these footprints, you begin to see opportunity where others see nothing. 2. Start with the business, not the chart. Before looking at any technical signals, I always start with a simple question: is the company worth owning long-term? For leaps trading, this is extremely important because time is part of the strategy. I look for companies that have strong revenue growth, a powerful long-term industry trend, no major deterioration in earnings. For example, right now many investors are watching sectors like AI infrastructure, cloud computing, advanced semiconductors, data centers. When the business thesis is strong, technical signals become much more meaningful. Dark pool volume without a strong company behind it is just noise. But when the fundamentals are solid, the chart begins to tell a much clearer story. 3. Look for structural consolidation. Once the business thesis is confirmed, I move to the chart. What I'm looking for is multi-week consolidation, usually something like 3 to 6 weeks of sideways movement. This type of structure often shows 3 important things. Support keeps holding, price refuses to break down, higher lows slowly start forming. This tells us that sellers are being absorbed quietly. Think of it like this. Every time the stock dips, someone steps in to buy it. Not aggressively, but consistently. That behavior often suggests institutional accumulation. If a stock is already moving vertically upward, the opportunity is usually late. Accumulation happens when the chart looks boring, not when it looks exciting. 4. Volatility compression, energy building. Another clue I watch closely is volatility compression. One easy way to see this is by looking at Bollinger Bands. When the bands tighten, volatility is shrinking, and markets tend to move in cycles. First comes contraction, then comes expansion. Think of it like a spring being compressed. The tighter it gets, the more energy builds. For leaps traders, this phase is especially interesting because option premiums are often more reasonably priced during low volatility. If you wait until the breakout happens, implied volatility often rises quickly, and option prices become more expensive. Entering during compression means you are positioning before excitement returns to the market. 5. Dark pool activity. Institutional footprints. Another powerful signal comes from something called dark pools. Dark pools are private trading venues where large institutional trades happen away from public exchanges. They allow big funds to buy large amounts of stock without immediately pushing the price higher. When analyzing dark pool data, I don't focus on one large trade. Instead, I look for patterns like repeated large block trades, unusually high dark pool volume, heavy buying near support levels. If large amounts of stock are trading, but the price refuses to drop, it can suggest that someone with deep pockets is quietly accumulating shares. This does not guarantee a breakout. Markets never offer guarantees. But when multiple signals start aligning, the probability of a future move increases. 6. Turning analysis into a leaps strategy. This is where analysis becomes strategy. If you wait until the breakout is obvious, several things often happen at the same time. Implied volatility rises. Option premiums become expensive. Retail traders start piling in. That usually reduces the risk to reward. Instead, I prefer entering during accumulation. For my leap strategy, I usually focus on deep in the money contracts, strong delta exposure, scaling into positions gradually. I rarely enter a full position all at once. Accumulation phases can last longer than expected. Patience is part of the strategy. 7. When the setup is not worth taking. Not every setup is worth trading. There are times when I simply step aside. For example, if the overall market is breaking down, bond yields are aggressively rising, company guidance suddenly weakens, implied volatility is already extremely high, confluence matters. No single indicator should make the decision alone. Good trades usually happen when multiple signals align together. 8. Turning market boredom into opportunity. One of the hardest things for traders to accept is that the market often rewards patience. Sideways markets feel frustrating. They feel slow. They feel unproductive. But these quiet periods often serve a purpose. They shake out impatient traders. They remove weak conviction. And they allow institutions to build positions quietly. When you begin to see boredom as preparation instead of failure, your entire trading perspective changes. As you can see, hidden accumulation rarely makes headlines. It is not dramatic. It requires patience and observation. But when several elements align, such as a strong long-term business thesis, multi-week consolidation, volatility compression, signs of institutional buying, you move from chasing breakouts to preparing for them. For long-term leaps investors, this distinction is extremely powerful. Instead of buying when excitement is already priced in, you secure exposure while skepticism still dominates the market. Because the biggest moves in the market rarely start with excitement. They start quietly, long before the breakout becomes obvious. If you found this helpful, consider subscribing to the channel. I share weekly insights about leap strategies, institutional positioning, and long-term investing frameworks. And remember, the market often rewards the traders who are patient enough to prepare before the crowd arrives.